we're all pretty much ready for us ending in negative territory, but a late flurry did see us ever so cautiously end in positive territory.
Just managing to pop our heads above the positive line, and if we have a look at the market, up by 0.1%, but it was quite an impressive performance given that it was always going to be quite difficult for the Aussie share market, with stocks like Westpac, Macquarie Group as well as BT Investments trading ex-dividend today, so they were a drag on the market. Really, I think the highlight of the session was those companies with exposure to overseas earnings. We saw stocks like News Corp up by 1.4%, ResMed up by 2.2%, QBE Insurance was up by 3.4%. Yes, and of course, as the Aussie dollar comes down, we see a positive impact on the earnings of these type of companies. So altogether, a great outcome for the Aussie share market, and on the back of those China numbers, which also came in line with expectations.
One of the big focuses today very much on a couple of, well, on the property space in general, but in particular Stockland and Mirvac. Interesting to take a look at these two, because seemingly going in slightly, well, very different directions. But maybe firstly on Stockland, generally if you have a downgrade to earnings guidance, you generally come in for a little bit of treatment on market. Not the case for Stockland today.
Well, they did come out with a downgrade. I think the market had already priced it in, and the fact that we are seeing a bit of stability in terms of the distributions in this financial year and next financial year are positive, and we know how much investors like that distribution and yield at the moment. So if we have a look at Stockland, previously they were forecasting that profit was going to fall by 20 to 25%. Most brokers' consensus was around a 24 to 25% fall anyway, and now today they've just come out to really confirm what was already out there in the market, that profit was going to fall by 25% rather than that range of 20 to 25%. But what they also came out to say is that their distribution in the current financial year, 24 cents, and the next financial year, 24 cents, should remain stable unless we do see further deterioration. So I think that comment really gave a bit of stability into the stock. We have a look at why Stockland's business is suffering. Well, we know that the retail construction market is a very difficult one, and instead of pouring more capital into some of its residential projects, what Stockland has been choosing to do is liquidate some of those residential construction projects. And so we have seen residential impairments hitting the business. In the office space, we're also probably going to start to see pulling back in terms of the assets, and that's over a more of a medium long-term program, but in the industrial place, trying to pick up appropriate assets in that space. So we got a clearer idea of strategy from the new CEO, and just the fact that we got a bit more stability in terms of distributions, the actual profit downgrade probably in line with what the market was expecting, and altogether we saw Stockland having a good day, and it was all about what was already priced into the stock.
About it a few times throughout the day. Well, a big fall. I think they were down about 13 cents today. Their share price now sitting at 10 cents when I last looked at it, just before the close. This is a company under a lot of pressure. They're blaming generally a contracting Australian economy, flagging about 150 jobs or so to go. The problem is that just the amount of projects out there isn't enough for them, and they can't get some of them.
It's an absolutely horrific day for coffee shareholders. The share price down by a massive 56.5% in one session, and it's really the geosciences division which is doing the damage. If you have a look at the announcement that came out today and the presentation that was attached to it, one of the charts on it is the number of contracts that's been cancelled each quarter, and the quarter that they're talking about, the one that we're in at the moment, you see this acceleration in the number of contracts that have been either delayed or cancelled. And I guess the worrying thing is the weakness really started in the mining space, but now that's spread over into infrastructure and oil and gas as well. So the last 6 weeks, they've actually seen 54 contracts being delayed or cancelled. So they have come out with a profit downgrade. Underlying EBITDA are expected to come in between $27 to $29 million. A big part of this story is the Aussie dollar. Yes, we are seeing a slowdown in some industries, and that's impacting, but also the strength of the Aussie dollar has been a problem, because if we have a look at some of their overseas contracts, the impact is less pronounced. They're still seeing quite good conditions in places like Christchurch, Calgary, as well as Toronto. So it does look like things are worse here in Australia rather than overseas. We are seeing a slowing down here, but a combination with that high Australian dollar seems to have really hit their Australian business quite hard.